Treasuries have seen a massive move higher in the last few days on fears about this nuclear crisis escalating in Japan. The 10-year yield hit the lowest level this year yesterday. So what are the bond markets telling us? Well, Jim Caron joins us. He's the global head of interest rate strategy at Morgan Stanley. Also, McKee with us as well. Before we get to the buying that's been going on, Jim, tell us what you make of the selling today.
Well, I think the selling today is largely off the CPI numbers and also off just some calmer situations in Japan overnight. Nothing really surprised us, and I think that we have a nice rebound in the equity markets, and some of the risk premiums are being taken out of the market. So some of the flight to quality is leaving Treasuries, and it's just natural that Treasury yields would rise.
And the gains we've seen over the last 3 or 4 days in Treasuries on pure fear.
Yeah, that's exactly right. I think it's important that we make a distinction between rising risk premiums and flight to quality and what are still reasonably good economic, robust forecasts for the year. So what I would say is that the market still expects there to be reasonably strong growth, 3.5% consensus growth for 2011, and headline inflation coming in around 2.3%. Now, those consensus expectations, particularly for inflation, are probably on the rise at this point. So what we're really seeing is a setup for good growth and rising inflation. So we're still very much in the recovery story, and that story is still on track.
Jim, a lot of speculation about whether Japanese investors would sell Treasuries to try to get yen back to the country. Never happened after the Kobe earthquake. Do you take that seriously? I
don't take that seriously, and I think that's one of the biggest falsehoods right now in the markets, confusing a lot of people. I mean, it would be natural to think that, sure, the Japanese own over 860 billion U.S. Treasuries. They would sell those Treasuries, get the dollars, repatriate that into yen, and then use the yen to pay for their, all the expenses of all the damages. But like you said, if you go back to the Kobe earthquake, we have other examples where this doesn't happen, and we don't think it's going to happen. In fact, what we would argue is that the insurance companies are going to pay for a lot of the damages out of premiums, not out of selling Treasury. So I think that's a complete falsehood.
So the Treasury markets aren't pricing that in at all?
That's correct.
Okay. You mentioned inflation expectations earlier, Jim. Is there any chance, though, that those inflation expectations could be reversed if this crisis in Japan gets even worse? Oh, absolutely. Now, if that happens, then what you're talking about is a growth scare. So right now, if we look at developed market growth, we're still tracking in the U.S. Sorry, not the U.S. in the global economy for developed markets at about 2.6%. Global growth at about 4.4%. So if there was a bigger catastrophe in Japan that had more reaching effects, or even in the Middle East, then you could see those numbers start to falter, and then you would get a growth scare, and then of course what would naturally fall is inflation expectations. Then that could happen. So it's really a question of sequencing. It's right now what we're seeing is the market's expectations are that we're going to get through the Japan disaster, we're going to get through the Middle East, and that we're still on track for reasonably strong growth and rising inflation.
Where does this put the Fed at this point? Are they on the curve, behind the curve, still ahead of it?
Well, I mean, according to the Fed, I think that they're right on the curve. I mean, but the one thing that's going to raise a question, though, is this rise in core inflation. Right now, I mean, the core inflation reached its bottom in October at 0.6%. Currently, we're looking at it at about 1.1%. Our forecast is that it goes to 1.8%. So what we at Morgan Stanley are telling clients is that, the Fed is effectively on track. They're probably going to stay on hold until the beginning of 2012. That just tells us that we're going to have accommodative monetary policy, but the Fed is probably going to start taking steps towards removing at least their language, their accommodative language, and start to think about the next cycle.
Jim, quickly, what I notice is that, for instance, this whole week we've seen so much selling in the equity markets. The S&P wiped out their year gains. Yet in the Treasury markets, even though you saw that buying, the yield curve didn't flatten as much as you might have expected as it did back in 2008. Why is that? Yeah,
that's exactly right. Now, look, the yield curve is one of the best barometers that we have for forward-looking economic growth. If you look back in 1992, the yield curve peaked at 265. In 2003, it peaked at 273. Currently, the yield curve is right at that 265 level, so it's still at historically steep levels. And one of the things that I look at here is, and I look at the yield curve as a barometer for economic growth, is that as long as the curve stays steep, what it's telling you is that monetary policy is accommodative. We still expect growth and inflation in the future, and that's good news. Forward looking.
It's been kind of resilient, really, despite all that we've seen coming out of Japan. Jim, thank you. I appreciate you joining us. Jim Caron, Global Head of Interest Rate Strategy at Morgan Stanley.